Hey guys, on this video, I have pretty good news for you, but don't get too excited just yet. And I'm going to explain why. On this video, I'm going to update you guys on what's going on with the latest inflation numbers from the latest CPI report. And I'd like to share some of the ramifications of what this report means for you moving forward. So let's jump into it. A really important and key measure of the price of consumer goods and services recently came out. And the latest report showed that those numbers have dropped, which basically means, guys, inflation is going down. So yes, good news, sounds good, looks good on the surface, all that good stuff. But like I said, don't get too excited. Let's dig into the CPI numbers, guys. CPI inflation rose just 5% in March, which is its lowest level increase since about May of 2021. So this is the lowest CPI increase in inflation on a month-over-month basis in almost 2 years. That's good to know. Now in February, just a month earlier, we saw a 6% year-over-year increase in the CPI numbers. So at 5% in March is great. This means some relief in terms of prices of goods and services, and more specifically in goods, right? Not so much in services. Now, CPI is broken out into a lot of different areas, and goods is where we really see this change in inflation. Not so much in the services piece, because the services is more tied to a strong jobs market. You guys know there's a strong jobs market out there still, but overall, a thumbs up for the American people in terms of inflation not going up at the rate it was. Now, last June, our CPI numbers were at 9%, just over 9%, which was the highest inflation rate in over 40 years. So seeing it down to only 5% here in March is a win. And seeing it trending down is good for, say, the stock market, right? Because if you're invested in the stock market and you see this inflation going down, that means more optimism for investors in the market, because it tells those investors that, hey, inflation going down like this means the Fed likely will not raise interest rates as much as they had been doing that, right? So it sort of sends a shock through the stock market to say, hey, let's put our money back in the market because we're going to see some growth. Remember this, guys, when inflation is high and the Federal Reserve is raising interest rates to try to lower it, that always has a negative effect on the stock market. The stock market usually goes down when the Federal Reserve raises rates. So seeing that inflation is cooling off, it really means that perhaps the Fed won't raise rates, and that would be a good sign for stock market investors. The Fed may pause its aggressive stance on raising these interest rates constantly. They've raised them 9 straight times in a row. And obviously, the reason they're raising those rates 9 straight times in a row is to slow down spending to cool off inflation. Well, if inflation is cooling off, they may not raise those rates again. And keep this in mind, guys. It's great news that we see inflation going down, but it doesn't mean that prices are falling, right? It only means that prices are not increasing at the same rate they were increasing, right? It just means that prices are not rising at the same pace that they were rising. Prices are still going up, but they're going up at a 5% clip instead of an 8 or 9% clip, which again is good. Now, there's another measure of inflation besides the CPI readings, right? There's also the core PCE inflation rate, which is actually what the Fed looks at a little more closely than the CPI number. The Fed looks at the core PCE because the core PCE purposely excludes food and energy, because they say food and energy are more volatile. They go up and down way too much. So they get rid of those 2 factors of food and energy, and they take a broader look at other factors. And so the core PCE numbers actually showed inflation was up just a slight bit this past month. But we're going to get a full report on the core PCE inflation in just about a week or so. And usually it sort of follows suit with the CPI readings, but not always. So just because the CPI reading was positive, this full core PCE inflation reading that we get may not be as positive as we think. So we'll keep a close eye on that, guys. And remember, the Fed is fighting inflation from 2 areas. It's fighting inflation by increasing the federal funds rate, which we know as the interest rates, right? We see that all the time. And the chair, Jerome Powell, he comes out and says, hey, we're raising the rate or we're not raising the rate, right? He gives his speech to the media after they have their 2-day meeting, right? But there's another way that the Federal Reserve fights inflation, and that is manipulating the asset side of their balance sheet. right? The Fed has a balance sheet with assets and liabilities. Now, right now, the Fed's assets total up to be about $8.6 trillion, right? And so their assets were only $4 trillion pre-pandemic. But during the pandemic, they added to their assets by pumping money into the economy, and this increased their assets to over $9 trillion at one point. Now it's down to $8.6 trillion because over the last several months, the Fed has been trying to lower their assets, right? They added a whole ton of money during the pandemic to stimulate the economy. And now they're trying to unload those assets to try to take some of the air out of the economy. So the Fed on a monthly basis is allowing $60 billion in Treasury securities and about $35 billion in mortgage-backed securities to mature and sort of roll off the books every single month, right? As they try to shrink their balance sheet and shrink their assets. They're allowing these mortgage-backed securities and these Treasury bonds to sort of roll off and mature because at 8.6 trillion right now, they want to deflate that number and get it down. They want to get their assets down, which actually takes money out of the economy, right? So that's another way that they're going about fighting inflation. It's not all about just the federal funds rate. So I'm keeping an eye on the balance sheet of the Federal Reserve as well, the asset side. Now, the overall point is this, guys. These latest March CPI and the upcoming full report of the core PCE numbers for March really increases the likelihood and the chances that the Federal Reserve will not raise rates again in just a few weeks when they have their meetings in May. Right? They have an open market committee, and that open market committee may end up saying, you know what? Let's not increase the federal funds rate this time and pause those Fed rate hikes. Now, right now, that's not the likely chance. Right now, there's roughly a 72% chance that the Fed is going to increase their federal funds rate again by 25 basis points or a quarter of a percentage point. But we'll have to see, right? That likelihood is going down because of the CPI numbers that came out for March. Now, if these core PCE numbers come out favorable as well, that will probably also help decrease the likelihood that the Fed's going to raise the rate again. But right now, the market has priced in the notion that the federal funds rate will be increased again by 25 basis points. But I also want you guys to consider the banking crisis that happened in early March as well. And that banking crisis actually, guys, did the Fed a favor because that banking crisis that had everybody up in arms, where you had the Silicon Valley Bank closing its doors and failing and collapsing, and then you had the Signature Bank of New York collapsing as well. Well, when that was happening and Credit Suisse over in Switzerland was having its problems, when all those things were going on back in March, guys, it made banks tighten their loan policy and tighten the extension of credit to regular consumers and credit to businesses. So in other words, it made it more difficult for individuals and businesses to go out and get loans. And so when that banking crisis made it more difficult to get loans, it was really doing the Fed a favor. Because remember, the Fed wants to slow down spending. That's why they increased the interest rates. So that you or your business, you don't want to borrow money at a higher rate. So you stop trying to get a loan. Well, when that banking crisis happened, it was sort of helping out the Fed's whole purpose of raising interest rates by tightening the extension of credit, right? So these tighter loan bank policies works right in line with what the Fed is trying to see when they actually raise interest rates. So again, guys, there's going to be another core PCE announcement coming out in just about a week or so, and that'll prove to be important for whether or not the Fed is going to raise rates or not. And it's going to shed a little more light on what happened with inflation in March. I know we have the CPI numbers, but these core PCE numbers are going to be important as well. And they'll give us a clue on where the Fed wants to go from here. Me personally, guys, I'm leaning towards another 25 basis points hike. But some people are saying, nope, that's not going to happen. Favorable inflation numbers means probably no interest rate hike, but we'll see. The good news for us, though, is the latest CPI numbers, guys, that show inflation is going down. This should relieve some pressure off the regular, average, everyday American citizen who's having a hard time purchasing items. And it could mean a rebound for the stock market, right? And we can begin to see some of our portfolios bounce back, right? We've been in the red for a long time now if you're an investor, right? And you probably want to see those numbers turn around. Now, I don't know about you all, but I've been watching my 401k and my investments, and they've been taking a nosedive for quite a while. But if you're anything like me, guys, keep investing, right? Keep investing. Keep dollar cost averaging, right? Because you're buying stocks on sale. You're buying undervalued stocks right now. And frankly, that's when the money is made in the market. It's when everybody's panicking and the market is dipped, right? When it dips, that's when you jump in and you buy. So I hope you guys, if you're investors, I hope you've been dollar cost averaging and continuing to invest in the market without panicking, right? The only bad news out of this is the fact that the buying season for serious investors who love to buy undervalued stocks may be coming to an end if the Fed decides to stop raising rates, because then you're going to see a jump in the market, right? The market's going to rebound really nicely at that point. And then, of course, the buying season will be over, but our stocks will be increasing in value, right? So, hey, guys, on this quick video, I wanted to share with you guys what these latest CPI numbers really mean for us. As you know, guys, I like to keep you updated on what's happening in the U.S. economy and give it to you in plain language. If you got anything at all out of this video, smash the like button for me, guys. Subscribe if you're not a subscriber. And also drop me a comment, guys. What do you think is going to happen with the Federal Reserve in terms of raising rates again? Or are they not going to raise rates? What would you like to see? Let me know in the comment section below. And check out a few of these videos right here where I dig more into the U.S. economy and what you should know. Hey guys, the best person to take care of the old you is the young you. Do me a favor, guys. Take care of yourself and always take care of other people. Until the next video, peace.